Okay, now we are continuing to question number 2, accounting paper 1, September 2020, balance sheet, notes and interpretation. The first part, 2.1, they've given us company transactions, and the requirement is for us to indicate the account to be debited, the account to be credited, and then the amount. There's also this information which is saying that the capital at the beginning was made up of 2 million shares of 8 million rand. Okay, let's go on to the transactions. Transaction number A. On the 1st of June 2020, the board of directors authorized the buyback of 45,000 of the company's shares from existing shareholders. A repurchase price was set at 9 rand each. An electronic transfer of funds was made to the shareholders for the shares that were repurchased. Okay, so when you are looking at the accounting equation, you need to remember your double entry. Remember, every time when a transaction takes place, two accounts are going to be affected. One is supposed to be debited and the other one is supposed to be credited. So according to our transaction here, there are more or less like two transactions that took place. Remember, our retained income is going to be affected, our ordinary share capital is going to be affected, our bank is going to be affected. Okay, fine. I'll show it here like this. The first thing that I want you to understand is that whenever a repurchase takes place, there is bank affected, ordinary share capital affected, and also retained income affected. Okay, remember this. When there is a repurchase, ordinary share capital is affected at average share price. Okay, bank, of course, at the amount at which the shares were repurchased, which is given here at 9 rand. And then the retained income is the extra amount above the average share price. Okay, so that is our retained income. So in other words, I can say that it is the bank minus the average share price. It gives you the amount for the retained income. Okay, so I would want to make it clear for you which two accounts are we going to record here. The one to be debited, the one to be credited. Here we are looking at ordinary share capital being affected, and we are also looking at bank being affected because of this transaction. And at the same time, we also have got retained income and bank again being affected. Okay, because all the money is here that we are dealing with. Okay, so let me just separate them like this. Okay, so ordinary share capital, remember, it's the average share price. How do we get the average share price? We look at the number of shares that are there, and then we divide the number of shares that are there, we divide them into the ordinary share capital that is given. So it's 8 million and 2 million shares. 8 million rand, 2 million shares. If we say 2 million into 8 million, we are going to remain with 4 rand. So 4 rand is our average share price, which means that our retained income, remember I said bank minus average share price, is more or less like we are saying 9 minus 4 rand, which will give us 5 rand. So the retained income is 5 rand. Okay, so the account to be debited, the account to be credited. Let's go back to grade 10. Okay, ordinary share capital or capital is part of the owner's equity, and then bank is an asset. Okay, and we know that owner's equity increases on the credit side, it decreases on the debit side. Bank increases on the debit side and decreases on the credit side. Okay, so what is happening to our owner's equity? Is our ordinary share capital increasing or decreasing? It is decreasing, is it? Because it's a repurchase. So we indicate a decrease. Whenever it decreases, it is going to be debited. Bank, what is happening to our bank because of the repurchase? Money is being taken out from the bank account to finance the repurchase. So it means our bank is also going to decrease. How do we decrease bank in the general ledger? We credit. Okay, let's do the same thing to the retained income and bank. Retained income is owner's equity. Okay, and then bank is an asset. Okay, what is happening to our owner's equity? It is decreasing. How do we decrease owner's equity? How do you show that in the general ledger? We debit. How do we show an asset that is decreasing in the general ledger? We credit. Okay, these are the entries that you are supposed to record here. So, okay, the account to be debited, the first account to be debited, of course, is the ordinary share capital. We credit bank. And then we also go on to the retained income against bank again. Okay, and then now the amount. Remember, the ordinary share capital is at average share price, is it? It's at average share price. So we are going to say the 4 rand, okay, multiplied by the number of shares that were repurchased. How many shares were repurchased? Remember, there were 45,000 shares. So we say 4 rand multiplied by 4 rand multiplied by 45,000, okay, which will give us something like 180,000. So here it's 180,000. And then the retained income, we're going to say 5 multiplied by 45,000. 5 times 45,000, which is equal to, let me just check with my calculator, it's going to be 225,000. 225,000, okay? So this is ordinary share capital. This one is for the retained income, okay? This is how you're supposed to record the first transaction. I hope you have fully understood all the steps that I've taken. Remember, the ordinary share capital, average share price, the retained income is bank minus average share price. You get the amount for bank, for the retained income, and so forth. Okay, now we are moving on to part B. Okay, what are they saying on B? There were 2 directors at the start of the accounting period. The directors' fees have been paid for the first half of the accounting period. The first half has been paid. So in other words, this amount, the 360,000, is for the first half of the year. For how many directors? 2 directors. Okay, so this is half of their money. If this is half, how much is the complete amount? We simply have to multiply it by 2, is it? To mean that, okay, fine, these 2 directors are entitled to something like 720,000 for the whole year. But for now, they've only received half of their money, which is 360,000, the 2 of them. On the 1st of January 2020, a 3rd director was appointed at a salary which is less than 10% than the old directors. Provide for the outstanding fees owed to the directors. Okay. So the first thing, like I've already indicated, you can already tell how much is one director getting. Okay, 2 directors got 360,000, and then they are saying this is half. So if you want to find even the half for one director, we can simply say 360 divided by 2, which is 180, is it? Which is half for one director. But to mean again that one full salary for a director is 360,000 per year. Is 360,000 per year, okay? The money for a director. And now they are saying that on 1 January is the mid of the year. Remember, their year begins on 1 July 2019. 1 January 2020 is the middle of the year. It's just 6 months remaining before the year end. They appointed another director at a salary that is less than 10% that of the old directors. Okay. So the first thing anyway that I'm going to show is a calculation here. Okay, just bear with me. My space is not big enough. Okay, I said the 360,000. The 360,000 is for the 2 directors, is it? For half of the year. To mean that the other half is also 360,000, which is remaining for the other half. So there is 360,000 accrued for the 2 directors who have been there. These 2 directors are still being owed another 360,000. Because here the question is saying provide for the outstanding fees to the directors. Okay, now we need to find out how much money is going to be given to this new director. They say that his salary is going to be 10% less than the salaries of the directors who have been there. And we have discovered that the full amount for a director for the whole year is 360,000. Okay, so we're going to calculate less. We are going to find out. Okay, fine. We say 360,000 multiplied by, if we are saying 10% less, to mean that 360,000 is the 100% amount. So when you say 10% less, we are removing 10% from a 100% amount. So in other words, we remain with 90%. We are going to multiply by 90% so that we can find out how much are they going to give the new director. Let's calculate and find out how much are we going to get. If we say 360,000, we are going to get 324,000. So this new director is going to get 324,000 for the whole year. But now let's consider this. This director was appointed on the 1st of January and the year is ending on 30 June. So the money that is due to him in this financial year is only money also for 6 months. So we're going to say this 324,000 times 6 months over 12. We are going to get something like 324 times 6 over 12. We'll get something like 162,000. 162,000 is accrued or is outstanding for the new director. Let me indicate new director. The new director is being owed 162,000. Why? Okay, 90% less. He's not going to get the same salary as the old directors, which means his salary will be 324,000 for the year, but he's only there from 1 January up to the end of the financial year, 30 June, which is 6 months. So to mean the money that is due to him is 162,000. And then for the old directors, they are being owed the same amount as the one that is given there, because this is indicating half, so the other half is the same amount, 360. So in order for us now to find the amount that we are supposed to record here, now we are going to say 360 plus 162. 360,000 plus 162,000. It is going to give us, let's check with the calculator, 522,000. So here we've already found the amount is 522,000. This is the money that is outstanding. Okay. So because of this transaction, again, remember every time when a transaction takes place, 2 accounts are supposed to be affected. Which 2 accounts are going to be affected? And from the statement here, you can already see that we are dealing with director's fees. And the other thing that they indicated is that provide for the outstanding fees. Is it? So I've got the director's fees and the accrued expense. Is it? The director's fees and the accrued expense. Okay, the director's fees and the accrued expense, they are the 2 items that we have. Okay, so when we say directors fees and then the accrued expense, if we put them on the accounting equation, directors fees, of course, they are owner's equity. Okay, they are owner's equity. Accrued expenses, they are liabilities. Okay, so what is happening to our owner's equity because of the director's fees? Our owner's equity decreases because of the director's fees, because they are expenses. At all expenses, they decrease owner's equity. Okay, the accrued expense, it is a liability, and the liabilities are increasing because of these accrued expenses, the expenses which have not yet been paid. It increases our creditors or our liabilities, all right, or our amounts payable. Okay, fine. So these are the 2 accounts. So when owner's equity is decreasing, what do? We debit. When liabilities are increasing, what do? We credit. So we've already seen how we're supposed to record in the general ledger. The account to be debited is director's fees, and the account to be credited is accrued expense. Accrued expense. Okay, I hope you have fully understood me on this one. It was a little bit tricky, but if you follow me exactly on all my explanations, I'm sure you get a full understanding. Okay, let's move on now to the last one. The last one that we have is C. They are saying Sophie, the debtor who originally owed 32,000, has been declared insolvent. His estate paid 40 cents in every rent, and the remaining balance must be written off as irrecoverable. This was not recorded. Okay, so a transaction has taken place. The first part of the transaction is that how much money here? They are saying that originally owing 32,000, declared insolvent. Okay, his estate paid 40 cents in the rent. The remaining balance must be written off. So we've got money that is going to be received from this debtor, and we also got money that is going to be written off. Okay, whenever money is being written off from a debtor, those are bad debts. Okay, so the debtor's control is going to be affected. The bank is going to be affected because of that money that is going to be received. And yeah, those are the accounts that are going to be affected: the bad debts, the bank, and the debtor's control. Okay, let me see if my space will allow me. Okay, let me say this will be the part 4C. Yeah, I'll do my calculation. So this one is a debtor, so we have got debtor's control. Okay, and then there's money that was received, so we have got bank. Okay, and then there's money that was not received, so it is also debtor's control against bad debts. Okay, So these are the accounts that we are going to open because of this transaction. Let's look at the first one for the money that was received from the debtor. Okay, if a debtor is going to, okay, a debtor is an asset. Let's go back to the accounting equation. Bank is also an asset. Okay, debtors control. If money is paid, if a debtor pays some money, the debtors are going to decrease. If money comes in from the debtors, bank is going to increase. So which account do we debit? Which account we are going to debit? Bank, and then credit debtors control, because it is being reduced. Also this part, if money we are no longer expecting to receive it from a debtor, what happens? Okay, it means our debtors are going to decrease, and then bad debts, it's owner's equity, it is an expense. All expenses, they always decrease owner's equity. Okay, and anything that decreases owner's equity we debit. So we debit our bad debts and we credit our debtors control because they are decreasing. Okay, so this is how we are going to record. Okay, I'll start with this one. Okay, for the money, the 40 cents that is going to be recovered, I would indicate bank and debtors control. Debtors control. Okay, for the second part, I would indicate bad debts. Remember, bad debts are being debited. Bad debts, this is an expense. And then also debtors control. Okay, so now we need the amounts. Okay, here remember they said 40 cents in the rand. So the first part, we're going to recover 40 cents. We're going to calculate 40 cents. I'll show it here. Okay, 40 cents in the rand is simply say 40 cents over 1 rand. And then you multiply by the money that was due, which is 32,000. Okay, if 40 cents in the rand is being recovered, how much is not being recovered? 60 cents in the rand is the bad debt. So you multiply by 32,000 again. So this is how you get your amounts. Okay, let's get the first amount is for the money that is being recovered. The last one is for the money that is being written off as a bad debt. Okay, from my calculator, the amounts become 12,800, 12,800, and then 19,200. Okay, so you record 12,800 and then 19,200. Okay. Yeah, it just looked as a simple activity whereby we are supposed to identify an account to be debited and an account to be credited, but it actually needed your full attention, and also you were supposed to read slowly and understand exactly what they are saying so that you could be able to record the proper transactions and also the correct amounts. Okay, so this is all on this company transactions. I hope you have liked this. I hope you liked this video. I want you to like it, and you must also not forget to subscribe on this video. Thank you.